Good afternoon everyone and welcome to today's Lunch and Learn webinar. Today we're going to focus on the Finance Bill, which was announced by the Minister for Finance last week. I'm delighted to be joined by my colleagues Talia O'Toole, who's going to address some income tax matters. My colleague Eamon Smith is going to address some of the business tax measures that were included in the bill. And finally, my colleague Etna Kennan is going to address the indirect tax matters that were included in the bill as initiated. Before we get started, just a few housekeeping matters to mention. At any time during the webinar, anyone can ask any questions that they want by virtue of just typing the question in the Q&A box at the end. And what we will try and do is address as many questions as we can where time permits. This webinar will be recorded and we will share it with all participants after the event. So without further ado, I'm going to hand over to Talia, who's going to talk to some of the business tax measures that were included within the bill last week. Talia, over to you.
Thanks, Brian. So there were a number of income tax measures in Finance Bill 2022, but I'm going to focus on three key areas. I'm going to look at cross-border tax relief for employees, foreign pension scheme matters, some benefit in kind changes, and then also address some of the committee stage amendments that will be expected in relation to keep share options and the unapproved share option arrangements. So moving on to cross-border matters first. The first one I want to address is SARP relief. So in relation to SARP, that provides a reduction in the 40% income tax rate to 28%, currently on remuneration between €75,000 and €1 million. That relief was due to expire at the end of 2022 for new entrants and has now been extended for new entrants coming into Ireland between 2023 and 2025. The eligibility criteria, however, for those new entrants have changed. To be an eligible employee now, an individual has to have a minimum annual base salary of €100,000, and that's an increase of €25,000 from previously. The individual also needs to have met the compliance obligations in relation to a PPS number. And in addition to that, the employer must have met its real-time reporting obligations in relation to new joiner and PAYE obligations. And those obligations need to be met within 90 days of the individual arriving in Ireland in terms of the PPS number application. And as you know, a SARP 1A form must be completed by the employer, which will now require the employer to certify that that PPS number has been obtained and that they've met that PAYE real-time reporting obligations. The other cross-border tax relief matter is in relation to the foreign earnings deduction. There's been no change to the actual tax relief measures associated with that. So for people who aren't aware of the Fed relief, it is a pre-tax deduction for the employee up to a maximum of €31,750 per tax year. It relates to qualifying work days performed in specific locations by the employee during a tax year. So that relief was due to expire at the end of 2022 and has now been extended again until 2025, which is a welcome move. The other area I'd like to focus on today is in relation to foreign pension schemes. So there were two specific pension scheme provisions introduced. The first is a new measure. It's in relation to a product called the Pan-European Pension Product, or PEP. So this is on foot of a European EU regulation to introduce such a product, and the Finance Bill 2022 measures are introducing the domestic provisions and tax reliefs applicable to that PEP product. So what is the PEP? Well, effectively it is a personal pension product that I can bring with me as I move cross-border within the EU, and it will be recognised in each EU member state. The individuals effectively will have equivalent tax treatment to that currently exists for an Irish PRSA. So employee tax relief will be given to contributions that are made up to the relevant earnings limit and the age-related percentage for that individual. There will be gross roll-up on any investment returns made within the PEP. Employer contributions will qualify for corporate tax deduction, and actually an extension of a BIK exemption to such contributions will be made for the PEP. And at retirement, similar tax reliefs available to a PRSA in terms of tax-free lump sum, and an option to transfer the fund into an ARF at retirement will be available. So that's a really welcome change. The foreign pension lump sum arrangements are also have been provided for in relation to Finance Bill 2022. So from 1 January 2023, Irish residents who are members of a foreign pension scheme are now going to be subject to a lifetime tax-free limit of €200,000 when they take a lump sum out of their foreign pension plan. So that's possibly a change to the previous tax position, but it aligns with the Irish domestic scheme provisions that exist in relation to tax-free lump sums. The caveat to that, however, is if I'm a member of both the foreign pension scheme and an Irish pension scheme, the 200k lifetime limit will apply to the combined value of both lump sums from the foreign pension plan and the Irish pension schemes. In terms of lump sums in excess of any tax-free limit that may be taken by the individual, similar to the Irish domestic arrangements, the first 300,000 of taxable lump sum from a foreign pension plan will be taxed at the standard rate of 20%, while a further excess above that will be at your marginal income tax and USC rates. So moving on then to some benefit in kind changes that were announced. There were three key changes to BIK in the Finance Bill 2022. The first is focusing on small benefit exemption. So as we know, that's a specific relief that allows up to one voucher of up to €500 in value to be given tax-free in any particular tax year. The Finance Bill provided for an extra voucher to be given tax-free with the proviso that the accumulated value between the two vouchers cannot exceed €1,000 in aggregate. So that's a really welcome change into that tax relief. There's also some changes to the Bike to Work scheme, which provided for an extension of the relief from income tax, USC and PRSI for individuals looking to purchase a cargo bike. And the value of that relief is up to €3,000 in terms of the purchase price of that bike. And that's effective from next year. And then to mirror some of the PEP provisions in relation to the BIK exemption for contributions to PEP, there's been a welcome change to the taxation of employer contributions to PRSAs. They are now going to be considered exempt from BIK from the employer perspective, and effectively that would align the tax treatment of employer contributions to an occupational pension scheme with that of a PRSA going forward. So that's very welcome. Of particular interest in the Finance Bill was a measure introduced in relation to a new reporting obligation for employers. So that it will be an electronic return as part of the normal statutory payroll return and real-time reporting obligations. Now this provision is subject to a consultation period and will be subject to a commencement order. But the aim behind the provision is to require employers to report tax-free payments made in relation to specific, what's been defined as reportable benefits. So those benefits are specifically the e-worker per diem, small benefit exemption and travel and subsistence expenses. Now, these are three key areas we're seeing coming up on an audit quite repeatedly, and obviously the tax-free status of those payments are subject to certain conditions being met at the employee and the employer level. So the move to a real-time reporting of these particular benefits will actually enable revenue to have full visibility on the quantum and the reasonableness of those payments, and could potentially lead to the ability for more risk assessments at a PAYE intervention level from a revenue perspective. Certainly it will lead to increased administration for employers as the system is rolled out. And then just moving finally to the committee stage amendments that we're expecting. So there's two particular amendments we're expecting. One is in relation to the Key Employee Engagement Programme share options, or KEEP share options. So we're expecting the Finance Act 2019 changes that refer to an extension of the relief to part-time employees and a broadening of the relief to group companies and holding companies to be implemented. We're also expecting provisions to be introduced which will provide clarity around the buyback of shares by a company for an individual holding KEEP shares, so that capital gains tax treatment would apply as opposed to an income tax distribution treatment. And there will also be some facility for the company to increase the level of shares that will be provided for under KEEP options. So there's an expectation of a doubling of that relief from the current 3 million in value of shares to 6 million in value of shares. And then specifically in relation to unapproved share options, there are two technical amendments expected. And these amendments are in line and expected in terms of revenue's particular focus on the area of employee compliance with share option exercises. So in particular, the two areas are the alignment of the interest rate for unpaid income taxes to that of RTSO. So RTSO is a payment that must be made within 30 days of exercise of an option. And in practice, that may not also often be charged where the RTSO is paid late. So now there's a technical move to ensure that that happens on a statutory basis. And the other expectation is that a fixed rate penalty will be levied on the employee for failure to file the RTSO form within 30 days of exercise. And the quantum of that penalty will be confirmed in the committee stage, but can be anything from 300 to 2 to 3,000 euro. So some interesting measures there. So that concludes my income tax section.
Excellent, Talia. Thank you for that very succinct summary. I have some questions that's come in, but what I'll do is I'll come back to those at the end. I just want to hand over to Eamon and just get Eamon to cover some of the business tax measures. Eamon, over to you, please.
Yep, thanks, Brian. So I'm going to cover a couple of topic areas, all under the bigger heading of business tax. So starting with a bit of financial services, then moving on to transfer pricing, and then I'm going to discuss the Temporary Business Energy Support Scheme, or TBES, some points on foreign exchange, on trading balances, and then going to talk about the vacant homes tax. So to kick off with some points on financial services. So first point is in relation to the bank levy. So the finance bill includes provisions to extend the bank levy to the end of 2023, and it maintains the base year of 2019 and the rate chargeable with respect to the dirt that was payable by the relevant financial institutions. Obviously, we've got 2 financial institutions leaving the country, so it will be on a smaller pool. The next point is on the banking levy modernisation. So last year's Finance Act included a provision to streamline and modernise the system for the collection of stamp duties on financial credit cards and on cheques, but this was subject to ministerial order. The Finance Bill 22 includes specific commencement dates for those measures, and the mentioned commencement dates are 1 Jan 23 or 1 Jan 24. So we'll see when the Finance Bill becomes the Finance Act what it lands on. The next point is in relation to the modernisation of health insurance levies. Excuse me. So the Finance Bill provides for the introduction of a streamlined and modernised system for the collection of annual levies that are levied on authorised health insurers, and this puts on a statutory footing the electronic delivery of statements to the Irish Revenue Commissioners in respect to these levies. And then the next point is in relation to the offshore fund rules. So Irish investors who have a material interest in an offshore fund are subject to a special taxation regime in respect of their income and gains in respect of those offshore funds. So under the existing rules, an interest in certain types of Irish registered unit trusts are considered an interest in an offshore fund where the trustees are not resident in Ireland. But the Finance Bill proposes an amendment whereby certain Irish unit trusts won't be treated as offshore funds, even if their trustees are resident in another EU or EEA member state, so long as the trustees are providing their services through a branch that's located in Ireland and the general administration of the unit trust is done from Ireland. So this amendment is welcome to those in the funds industry and in the income tax space, because it removes some historic uncertainty that was kind of present in relation to the treatment of those kind of funds. And then the final point on financial services is in relation to securities transferred by electronic means. So the Finance Bill provides updates on the application of stamp duty on the trading of securities by electronic means. So these provisions, which I think originally came into operation on the 30th of March 2021, have been updated to clarify that a stamp duty charge under these specific provisions will arise in respect of transfers of securities by electronic means. It also brings in a record-keeping obligation in respect of such transfers, but that will be limited to the operators of the system where there is an agreement in place with Revenue in relation to that system. Now the standard obligation to maintain records will still apply for people who enter transfers into the system.
Yeah. And even just on that, if I can ask, does that impact on the stamp duty treatment of the transfer of securities under a conventional system?
No, so the standard stamp duty charging mechanism should still continue to apply for transfer of securities by non-electronic means. So this is kind of an incremental.
For electronic.
Yeah.
Thank you.
So the next topic area is in relation to transfer pricing. So with effect from 1 Jan 23, the Finance Bill proposes to amend the reference in the Tax Acts, which currently refers to the 2017 OECD transfer pricing guidelines, and it's going to update that to the 2022 OECD transfer pricing guidelines. And the key difference between those two sets of guidelines is that the latter incorporates guidance with respect to financial transactions in a new Chapter 10. Now, Irish Revenue's view has been that applying the updated guidelines is in line with best practice, but this now puts that position on statutory footing once the Finance Bill becomes the Finance Act and is passed. So it does mean that financial transactions are now formally within the scope of that OECD 2022 transfer pricing guidelines on financial transactions. So the next topic is in relation to the Temporary Business Energy Support System or Scheme, or TBES, very unfriendly acronym. But so broadly, the TBES has been introduced to try and help businesses over the coming months to get relief or to be supported with respect to the rising energy costs. So the scheme applies to persons who carry on a trade or profession, which is case 1 or case 2. And it's also applicable to charities and approved sporting bodies who might also carry on a trade, notwithstanding the fact that that trade might be exempt from income tax or corporation tax if they are approved by Revenue as charitable bodies or as approved sporting bodies. And in order for the business to qualify, it has to demonstrate that the average unit price for either electricity or gas, it applies to both, on the relevant bill has increased by more than 50% as compared to the average unit price for a reference period. And the reference period is defined at length in the bill with reference to a number of formula.
Yeah, I think on that, Eamon, certainly just given the whole cost of living crisis that's going on and the significant increases in costs, energy costs, particularly for businesses, this is probably something that a number of our clients are going to be availing of or are going to be impacted by it. What are the specific conditions that need to be met in order to qualify for the TBES scheme?
Yeah, so in order to make an application so you have to have that, you have to be able to demonstrate that there was that increase in your energy costs, be electricity or gas, of over 50%. As compared to the average value for the reference period. And then in order to make the claim, the business in question has to be tax compliant. It has to be eligible for a tax clearance certificate. It has to have been carrying on the trade or profession and continue to do so after the end of the claim period. I should mention that the claim period at the moment is 1 September 22 to 31 December 22, but the Minister has the ability to extend that to 30 April 23. So that may be extended in time depending on how energy prices go. And then the fourth condition is that the business in question has to register for the TBES provisions through Revenue Online System, or ROS. They must file a claim for the relief, and they must also sign a declaration that says they satisfy all of the relevant conditions. So then in terms of what does the relief entail? So a qualifying business is entitled to make a claim for a payment to be made to them for 40% of the increased cost in either the electricity or the natural gas, whichever is applicable, and then that is capped per claim period, which I think is per month, at €10,000. But if a qualifying business has more than one premises, and therefore has either more than one MPRN, which is the meter point reference number, or GPRN, which is the gas point reference number, that can be increased per location. Now the locations can't be adjacent to each other because their adjacent locations are counted as a single premises for the purposes of these rules. And then that cap is increased to 30,000 per claim period. So if you've got if you had 3 businesses in 3 different parts of the country, you could potentially be eligible for €30,000 per claim period.
Mm-hmm. And I suppose, in addition to those caps on the claims, are there any other limits that were included within the conditions for the TBES regime, Eamon?
Yeah, so the overall kind of relief under the scheme is capped at €500,000, but that cap also includes any payments that have been made under the temporary crisis framework. But if you are a farmer and carrying on a farming trade, the cap is €75,000, and it's €62,000 for a farmer, and it's €75,000 for a person who's engaged in the production, processing and marketing of fishing and aquaculture products. So for your standard business, you've got up to €500,000, incorporating any other payments that have been made under the temporary crisis framework. And if you're a farmer, you get less, and if you're a fisherman or someone processing fish or whatever, then it's also slightly higher than the farmers, but it's a lower threshold than the €500,000. And then another point, which is kind of back in the financial services realm, is in relation to foreign exchange on trading balances. So the Finance Bill kind of confirms the treatment of foreign exchange gains and losses when computing the profits of a trade. So the proposal under the bill has the kind of the effect to provide that the FX movements, which are going to be gains or losses, relating to trade receivables and then trade-related bank deposits are to be taken into account when computing a company's taxable profits. And this, now, I think we broadly would have considered this to be applicable anyway, but this puts kind of a bit of clarity around the position and puts it on a statutory footing. And then the final topic that I'll talk about is the vacant homes tax. So this was announced on budget day, and the stated aim is to try and maximise the use of the existing housing stock, both for rent and in terms of purchase. So the bill sets out a lot of details in relation to the vacant homes tax, and it will apply to residential properties, or apply to properties which are residential properties for local property tax or LPT purposes, and where those dwellings are in use for less than 30 days in a 12-month period. So each chargeable period has a duration for vacant homes tax purposes has a duration of 12 months, and the first period starts on 1 November of each year, and as I said, goes for 12 months. So the vacant homes tax, if it is chargeable, is charged at a rate equal to 3 times the base amount for the LPT in respect of the residential property for that period. And the fact that it's the base amount for LPT means that it's stripping out any kind of specific locality adjustments. So you might have places in Dublin adjusting the LPT base down, you might have places in other parts of the country adjusting it up, but it's the base amount. Yeah. So the person who is chargeable to vacant homes tax is the person who owns the residential property on the first day following the end of the chargeable period. And if a property is subject to a bona fide tenancy, and that tenancy is registered with the Residential Tenancy Board or the RTB, and it lasts at least 30 days in a chargeable period, then those homes are not subject to the vacant homes tax. And the tax will operate on a self-assessment basis, and it will be administered by the Irish Revenue Commissioners. The filing date for the return in respect to the vacant homes tax will be 7 November. So that would be after the end of the chargeable period. And the date for paying the tax, at least in the bill as provided, will be 1 January. So it will be a couple of months later. And that there are interest and penalties and late filing surcharges can apply if there's an instance of non-compliance. And obviously these provisions will become effective when the bill is actually passed into law.
Mm-hmm. And Eamon, did the bill include any specific exemptions from the vacant homes tax? Because obviously there's a number of properties that might be for sale or a vacant for rental purposes. Are they exempt, or what type of exemptions were included within the bill?
Yeah, so there's a reasonably long list of exemptions that are provided for under the bill, just to ensure that owners of properties are not unfairly taxed. if the property is vacant for a genuine reason. So the exemptions, some of the ones that I mention are where the property is sold during the period, if the property is actively being marketed for sale or for rent, and I think there are certain conditions that attach to that particular exemption. If the property is vacant because the chargeable person has illness or is undergoing long-term care, and if prior to that they occupied the premises as their principal private residence. So that might be applicable if an old person is put into a nursing home, or if someone has a serious illness and they're in hospital for a long period. There is also an exemption if you're undertaking significant refurbishment works, but for a period that is not less than 6 months in the chargeable period. And there are some conditions to that exemption as well. And also there's an exemption if the property is vacant because occupying the property is prohibited by court order. Now there are a few other exemptions as well, but those are the primary ones.
Excellent, Damon. Yeah, quite a bit in those various business tax measures, but thank you for running through that. Etna, I'll hand over to you to talk us through some of the indirect tax measures that were included within the bill and initiated last week.
Thanks, Brian. So I'll look at customs and excise, and then I'm going to move into VAT. The VAT area is the one that I'll really be focusing on. There were a number of measures there, ranging from dealing with VAT rates and VAT exemption, VAT procedures. So I'll go into those. But I'll start with customs and excise, and I will say I have an easy enough start because there were no customs provisions in the finance bill. But looking at excise, there were a range of procedural measures, technical measures. To give some examples, the finance bill confirmed the excise duty increases. There are some usually old reliables. So for example, the increase tobacco packs of cigarettes. But the finance bill also confirmed the excise duty reductions in rates that they will extend to the end of February next year. So if we look at petrol, diesel, marked gas oil, take for example a 21-cent reduction, that includes VAT for petrol per litre, 16-cent reduction for diesel per litre, and at least in a welcome manner that's going to be extended out. Separately, the finance bill also looked at betting duty. So this is another excise obviously on betting, and in particular was looking at an area of, say, where you get a free bet or a discounted bet. So what it clarifies is that where the person placing the bet is paying less than the actual amount at stake, it means that, say there's a free element or a discount element, that will be included within the amount that's subject to tax, subject to this betting duty. So in other words, the betting duty would take into account the full value of the stake, not so much what the person has paid for it. Moving away from customs and excise and into VAT, again, a number of measures. And as I said, they're administrative nature, they're ones dealing with VAT rates and also with VAT exemptions. So they're the ones I'm going to focus on. Looking at the administrative and operational matters first, one point is that Revenue's powers are being extended under the proposed finance bill provisions to request information from financial institutions in Ireland. This is on behalf of where, say, a tax authority in another EU country wants that information. So that's extending Revenue's powers to do that. Another procedural operational matter that the finance bill is looking at, and it's like what Eamon said before, it's about putting some practices with a statutory basis, a statutory footing. We already have an administrative procedure of a two-tier VAT system. Well, I should say a VAT registration system. So some viewers will know that their business has a domestic VAT number, other businesses have a VAT number that equips you to deal with other EU countries. So this was an administrative procedure. It wasn't a solo run by Ireland, some other countries have it as well, that was introduced before COVID. But what the finance bill has done is put this on a statutory basis and is saying, look, you may have a domestic number when you start, if you start carrying out business with other EU countries, tell us within 30 days. And that really means you need to upgrade, change over your VAT registration. Elsewhere in VAT, as I mentioned, there were a number of provisions proposed about VAT rates. So starting off, and I know Brian, you'd mentioned about energy and about the energy crisis, we know that there's a temporary 9% rate for gas and electricity. So the finance bill confirms that that's being extended out to next February, because otherwise that would have expired this month. That temporary 9% rate, though, there weren't told winners on this one, because as we know, it was already flagged in the budget that the temporary 9% rate that certain activities in the hospitality sector, they enjoy this temporary 9% rate. That's not being extended. So just to mention what the finance bill does not include, it doesn't include an extension of this 9% rate for hotels, restaurants, museums, galleries and the like. So just to mention that those activities will revert back to their normal treatment at the end of February next year, their normal treatment typically being going up to 13.5% then. So elsewhere in VAT rates, the finance bill focused quite a bit on the 0% VAT rate. So the 0% VAT rate is a little bit of a Goldilocks VAT rate for businesses if they qualify, because it means that you're obviously not collecting cash VAT from your customer on the price you're charging, but you're nevertheless entitled to get VAT recovery on related costs. So the finance bill looked at some zero-rated activity and in a welcome move has proposed that there are exclusions, but certain newspapers and also electronically supplied newspapers will qualify for the 0% VAT rate. That would come in from January of next year. And that means a move down from 9%. So really an extension of the 0% rate. Other examples of extensions to the 0% rate, health products. So automated external defibrillators, hormone replacement therapy, nicotine replacement therapy. There was already relieving measures for oral health products, but this is aimed at non-oral. So say your patch would get 0 rating from January. Also, other examples of the 0 rate being extended, say period products that weren't already being 0 rated, the 0 rate is being extended to those. But there's an example where the 0% rate is being narrowed, and it's interestingly in the food and drink sector where VAT rates are notoriously tricky in that area. But at the moment, we'd have a 0% VAT rate for milk and for preparations derived from milk. So what the finance bill is proposing is to narrow that down, remove the 0 rate from the preparations and the extracts derived from milk. Now, where do they go? If the 0 rate is removed, it means that those products go back up to 23%. So that would be quite a difference on the shelf, on the milk shelf, as it were. So elsewhere in VAT, as I mentioned, we've already looked at some VAT rate changes, but also the finance bill looked at VAT exemption. So just setting the scene there, the difference with VAT exemption is, again, you're not collecting VAT on the price you're charging, but typically no VAT recovery for the supplier on their related costs. So looking firstly at VAT exemption for activities in the public interest, the finance bill looked at medical services, professional medical services, and there are different views, I suppose, about what actual impact this will have, but here we are. Right now, there are certain professional medical services that are VAT exempt because they're recognised as, professional medical services by the Department of Health and Children. And it didn't so much matter who you were in providing that service, it was more what you were doing. So the proposed change will be it will also matter who you are. So the aim is to look at VAT exemption applying to professional medical services that are provided by a designated medical profession, a registered medical practitioner, midwives, nurses and the like. So look, there's a lot here that won't be changed, but it could mean a narrowing of some types of medical services and the VAT exemption applying to those. And then also, the last part of the content I have on the indirect taxes, I'm still sticking with VAT exemption, but it's VAT exemption in the financial services area, and in particular to do with funds. So where we are at the moment is that the management of specified investment funds, so certain investment funds as defined under VAT legislation, the management of those funds in Ireland is VAT exempt. So that obviously impacts the the fund manager, the fund administrator, not charging VAT. So there are a couple of changes proposed there by the finance bill. The first one is to remove the VAT exemption if you're providing agency services in respect to fund management. Now, on that one, there may well not really be widespread impact in practice, obviously case by case, but another measure which will need to be looked at, again, VAT exemption, is looking at the management of other vehicles that are considered to be these specified investment funds. So what I'm talking about here are Irish tax resident companies that are special purpose companies or Section 110 companies as they're referred to. And they're normally at the moment regarded as qualifying for VAT exemption when they're managed. The proposed change though is to look specifically at the Section 110 companies that hold qualifying assets that are plant machinery. So it's looking at plant and machinery, Section 110 companies. An example here would be in aircraft leasing, if you're holding aircraft. And the logic of the finance bill is to remove VAT exemption on the management services that are provided to those vehicles. So what that means in practice is, if it's enacted, the fund manager would need to start charging VAT. So that'll be a fundamental change. In terms of VAT recovery, it may not be all bad news, because depending on the level of activity, what's actually going on within the fund may have VAT recovery. But it's really down to looking at the activity within the fund to work that out. And it is possible that there could be irrecoverable VAT arising. I should mention that's proposed to be brought in from 1 March of next year. And then my last VAT exemption proposed provision by the Finance Bill, it's again to do with funds, but it's to do with non-Irish EU funds. So as I'd mentioned, the management of specified investment funds in Ireland, typically VAT exempt. So what about their equivalent in other EU countries? What the Finance Bill is aiming to do is to similarly apply VAT exemption on equivalent funds in non-Irish EU countries. So in Ireland, obviously, we'd have exemption on, for example, UCITS and alternative investment funds. So if this is enacted, it's bringing those services into VAT exemption. And what that means for a number of, you've got fund managers and administrators in this area, is a potentially negative impact on their VAT recovery. And what that really means is an increase in their cost base. So it's something that I think we'll need to watch. If it is enacted, it will be a change from long-standing position and practice in the area. But what you'd expect is there would be some consultation and discussion with Revenue about this in the coming while, and really it's going to be one to watch and to see how these provisions are developing as we're moving through with the Finance Bill as initiated towards actual enactment. So they're the indirect tax procedures that I wanted to cover.
Excellent. Edna, listen, thank you very much for that. We've a number of questions that have come through, just scrolling down to them here. So Edna, I'll give you a break for a few minutes because there's a few here for you, but Talia, I'll turn over to you. And a question here that has come in on SARP. So what the question is that the reduction in the level of income tax relief under SARP as a result of the threshold change doesn't seem too significant, but will the other amendments cause any issues?
Yeah, it's a great question. For new entrants who are eligible for the relief, the actual quantum in the reduction of the relief is only about €3,000 per tax year because of the increase in the base salary to €100,000. However, that increase in €100,000 may of itself preclude new claimants to actually be eligible in the first place. The key area of focus, I think, which will prove most challenging, are the compliance aspects from the employee perspective and the employer perspective. So what we're seeing in practice before the statutory footing was SARP 1A forms being returned to the applicant because no PPS number was already in place or because tax registration hadn't happened. So by putting it on a statutory footing now, it's effectively saying if you haven't got your PPS number issued to you within 90 days, you're totally kicked out of the relief for the entire potential 5-year tax period. The other element from an employer perspective is, notwithstanding the employee has satisfied all of the conditions and got his or her PPS number, if they have not complied with the PAYE regulations in relation to being a new joiner, they're potentially kicking that person out of SARP relief for that potential 5-year period. So that could obviously cause some internal issues between the employee and the employer. So I would really recommend employers to just focus on what their current processes are in place around payroll and the implementation of those regulations.
Okay, thank you, Talia. And another question for you, Talia, that's come in. No surprise on reportable benefits. I think obviously this is going to impact every employer practically, so I think there'll be a lot of interest in this one. But the question on that is that the requirement to electronically report specific tax-free payments as part of POE reporting is an interesting development. What will that when will that likely be introduced?
Yeah, so we don't have full visibility on that yet because it is subject to a consultation period and then also a commencement period. So employers will remember there was quite a lengthy consultation period in relation to the implementation of real-time reporting in the first place, which eventually applied from 2019. What I'm expecting at a minimum, it will be 2024 before these provisions are enacted. And that's primarily to give time for the ROS changes for statutory payroll returns and third-party payroll software technology changes to be implemented. what I'm expecting is sort of feedback from revenue as to what the level of information employers need to provide as part of those forms. But it's really important now, I think, for employers to begin assessing, well, where is the information housed within their systems, whether it's accounts payable, their expense systems, or some other system, so that they know how to get at that information and actually what the quality of that data looks like. At the back of all of this is revenue looking to understand the quantum of tax-free payments being made to someone. And that tax-free status is contingent on meeting certain criteria. So certainly, again, I would encourage employers to take this opportunity to assess, well, what are our current processes and procedures around tax-free reimbursements? Are we meeting those data requirements as it is before moving to this electronic reporting format? As I mentioned, it's an area of focus on a revenue audit, and then once implemented, revenue in real time will have monthly data about the level of tax-free payments that will be made, and that can only serve to help revenue make risk-based adjustments around payroll tax interventions.
Yeah, like it is interesting that the bill included legislation on this. However, it's obviously subject to commencement order to allow for, I suppose, a period of consultation with industry representatives, advisors, and payroll providers. Whereas you might have thought they do the consultation first and then maybe follow
and then
the law.
bring it in. Yeah.
But anyway, I think there'll be a lot of interest in that, and I think a lot of people, including ourselves, will be feeding into that consultation process. Yeah. One last one for you, Talia, and we'll give you a break. Just on the small benefit exemption. Yeah. It's questioning as to whether it applies for 2022.
Yes, so the effective date is actually a retrospective date back to the 1st of January 2022. And that's actually really positive. It also means, however, if employers have been tracking the number of vouchers, they might actually have already paid some tax in real time through payroll in respect of some vouchers. That can be reversed, right? And it also, some employers may have entered into what's called a PAYE settlement agreement, or will be entering into PAYE settlement agreement for 2022, which applies for minor and irregular benefits. So vouchers which would have previously been in excess of this new €1,000, in excess of the €500 limit, but now could be considered tax-free, obviously can be removed from that PAYE settlement agreement now.
Excellent, thank you for that, Talia. Etna, as I said when you finished talking through your various pieces, there's some questions on the VAT side, so I'll throw them over to you here, just a couple of them here. So first one, the 0% VAT rate has been extended to some newspapers and e-newspapers, but there are some exclusions. In practical terms, what issues do relevant businesses need to consider, and when can they see the benefit of the VAT rate reduction, excuse me.
No, thanks. Well, look, this reduction to 0% firstly has been welcomed as a measure to support that sector. The problem with VAT rates is, as this question is alluding to, what goes in and what falls out. So what it's aimed at covering are newspapers and electronic newspapers. It's not aimed at covering periodicals. So it nearly becomes a philosophical question. It might be quite obvious what a classical or classic newspaper is, but there are going to be a number of very popular titles that really the line is a bit blurred. And actually, is it 9%? Is it 0%? What's going to happen? One other exclusion that will need to be watched to see does it exclude these products moving to 0%. You can't have a newspaper or electronic newspaper that's predominantly or wholly devoted to advertising or to audible video content or audible musical content, videos, that kind of thing. So it'll really be about looking at what actually is it and can it get the 0% rate. But I also think that question brings up a good point about the when, because we know the aim of when these rates will be introduced. But the problem is that if that comes in, in January, say if I get a subscription as a gift for my loved newspaper before Christmas, we can get into some tricky rules there about when do you owe the VAT. Because if you get an advance payment, a prepayment effectively, you could be triggering a VAT bill at the 9% rate before Christmas. So it's just going to be one to watch to see actually to what extent the 0% rate can be applied. And it's something that I'd just be recommending any relevant vendors and businesses dealing in this to really take a look at it. But again, it's very welcomed measure.
Yeah. Another one for you, Edna, you mentioned the two-tier VAT registration system. How does this impact on businesses in practice?
Yeah, well, this was brought in pre-COVID, and I should say there are a number of businesses out there who have never had to think about the two-tier VAT system because they have an older VAT registration, which effectively was an all singing, all dancing registration. It served so many purposes. But since this two-tier system was brought in, and particularly we've seen from 2019, you say on day one to revenue which type of registration you want. And there are many businesses that are effectively not impacted by this because if we look at a post-Brexit environment, if you're importing goods from a non-EU country, which now includes Great Britain, you don't need an intra-EU VAT number to deal with that if what your international trade is bringing in, say, goods from a non-EU country. So it's very much going to depend on what the business is doing and what you think you're going to be doing. What the intra-EU VAT number is aimed at doing is letting you convince a foreign EU trading partner that you're a business, so that, for example, can buy goods and get them out of the other EU country at a 0% VAT rate. And the difficulty in practice is that if you give the domestic VAT number to your vendor in another EU country, we're seeing situations where they say, that's not a proper number. It's not valid because it's not the right kind of number for them. So it can be very straightforward to do it. But I think what the Finance Bill is trying to achieve is to leave aside the administrative practice and just really put this on a statutory basis and to encourage businesses when they start doing the intra-EU trade to notify revenue and just get their VAT registration upgraded, if I can use that term, to the intra-EU one. And then that way the business can just keep going and trade effectively and efficiently with other EU countries.
Yeah, and then just an extension to that, how can you tell the difference between a domestic VAT number and an international VAT number?
Yeah, it's a funny one because at face value they look exactly the same, but each country has our own prefix to denote which country is given the VAT number. So an intra-EU VAT number has an Irish prefix, i.e. at the beginning when we got it from the Irish Revenue. But the real test is that there's the European Commission website, and if you plug in a VAT number, you have to tell which country you think it came from. But you plug in the VAT number, the computer will either say no or yes. So it's very easy for the person you're doing business with to effectively type in the VAT number you're giving them, and it's not going to come up as a valid number if they put in a domestic number. So that's the real practical check that's being done all the time by your trading partners, and that's how you can tell. Then as soon as you have the intra-EU number, look, there can be some delays in updating any system, but the aim is that it means when you give that number to someone, it's meaningful, they're going to find it in the system they're looking at.
Yeah, but it's the international prefix.
It really is, yeah, the rest of the number is exactly the same. Yeah.
Final one, Edna, for you. Regarding VAT changes on food and drink, we've had a question about the proposed removal of 0% VAT for certain milk products. And what kind of practical issues should wholesalers and retailers be considering?
Yeah, and I think it's timely to be thinking about this kind of thing because obviously the Finance Bill has to go through different stages and then it has to be enacted. But for any retailer, wholesaler, manufacturer, they want to be thinking ahead about their systems issues. How are they actually going to deal with any VAT rate changes, whether it was a positive VAT rate change or a less so. So it's timely to be thinking about, will they be equipped to deal with a VAT rate change? Specifically for this one, as I mentioned, it's aimed at dividing your milk shelf between milk versus the preparations and extracts derived from milk. So just to give an example, you could start getting a little bit philosophical. Milk is milk. What about strawberry milk? You know, and this kind of linear, or rather granular, I should say, process really does need to be carried out. So what it actually means for businesses is they look at their product range. They look at what their role is. Are they the manufacturer, the wholesaler, the retailer? They look at their product range and they see actually to what extent could this potentially be impacted. But in practical terms, what you'd expect would be that revenue will issue further guidance, because in the past they've had some practices and helpful guidance, even saying, look, is there more than 50% of milk in this product? You know, and that kind of guidance has been very helpful in the past. So really the hope and expectation here would be that more revenue guidance will be forthcoming if this is enacted.
Very good. Thank you for that, Edna. Eamon, just one very quick question. It's a very specific one. We may need to take this away, but just in relation to the vacant homes tax. Are holiday homes exempt from the vacant homes tax if the property is used for holidays for more than 30 days per year? I think it is, but I'm not sure if you know that off the top of your head.
Yeah, off the top of the head, not sure, but I think that the provisions do apply if the residence is occupied for more than 30 days, because you even see that if it's let out for more than 30 days. So obviously we can take it away and check it properly, but I think once more than 30 days, I think 30 days is the threshold, so less than 30 days and you've got a problem. or more than 30 days, I think it might be all right.
Yeah, I think that's right, Eamon. And what I'd ask is the participant, it's just come up as anonymous who asked that question, if they want to either drop me an email or your KPMG contact on that particular question, and we can confirm it definitively for you, okay? Thank you for that. Talia, the last one I'm going to throw over to you, just on the reporting. As I said, a lot of interest in this, but does the reporting apply to tax-free expenses paid according to the revenue rates? So the travel and subsistence.
Yes, so we need to sort of see more detail, but I imagine, yes, it should be.
Yep.
So it's anything to do with tax-free payments, because even on an audit, we're finding that actually the rates might not be actually the rates per revenue that are being reimbursed. So, or if the rates aren't being applied in the right way. So yes, I would expect it to be even with revenue rates, yeah.
Excellent. Well, I think we'll leave it at that for today. I think we've covered a lot of the questions that have been asked here. So I just want to thank all of our participants for attending today's webinar on the finance bill measures, and also for the litany of questions that we've received today. So thank you, everyone. I'd also like to thank my speakers today, Talia, Eamon and Etna. And lastly, I just to say to people, if, for example, you have any other questions, don't hesitate to contact any of us here on the panel or your respective KPMG contact, and we'd be happy to address any questions that you have. So thank you very much and have a good afternoon.